This is lesson 4, and it's probably my favorite lesson to teach, because it's like, it really isn't necessarily about investing. It's about why your investments do what they do. And it has to do with economics, which really is a sleeper topic for many people. But if you can follow the sequence of the lesson tonight, it'll help you so much as a bond investor and as a stock investor. So I really enjoy teaching this because it's helped me personally so much to be a much more patient investor. But before I do that, I have to tell you, I might be a little off on the class tonight because I just had like a traumatic day today. If anybody follows Adventures in Investing, you know that the mascot of Adventures in Investing is AJ, the Lab Retriever. And I walk him every morning. That's how I get my day started. I take him out usually to the Wirewash Trail or someplace like that, and we get in 6 to 8 miles. And AJ has a great time, gets him all warmed up to the day for his naps. So he's just a great dog. He's just a super dog. But this morning, I was walking on the Wirewash Trail, and I was out by where Double G and Wirewash Trail intersect. And I'm walking along, and I saw this family coming, a husband and a wife and a small child, and they had 2 dogs. So I had AJ on a very short leash because I just don't. If you don't know the person and know the dogs, you want to make sure your dog's safe. And as I approached, I saw that the father had a pit bull. And so I'm always leery about pit bulls. I know people tell me they're great dogs and they're fun and everything else, but you never really know. And so I walked past him, and there was no incident. The pit bull looked at AJ, and AJ just walked on the side. And I got up about 15 feet, and I was passing the wife, who had a black lab, looked just like AJ. And all of a sudden, this pit bull does a Houdini move. It was interesting because the people that have dogs with harnesses on, not just a leash but a harness. This dog stood on its back legs, jumped in the air, twisted around, and extracted itself from the harness. And in a flash, came running over and just glomped onto AJ's leg. It was just shocking how fast it happened. And fortunately, we got him off of AJ, but the damage was done. AJ got really, he had 4 big bite marks in the upper part of his leg. I'm sitting there, and I was just like, what do you do? And I was making sure he was feeling good. And the guy says, well, I'll put the dogs they were parked about 100 yards away. He says, I'll put the dogs in the car, and I'll be back, and I'll give you the information. Okay, him and the family walked to the car and drove away. So yeah, it was bad. But anyway, I did get AJ. I called my sister because AJ couldn't walk, and we got him to the vet. And he doesn't have any broken bones, but he has deep contusions into his muscles. So he just had his rabies shots, so we're not worried about rabies. But he can't put any weight on this leg. Now, one of the reasons why I even bring it up is because I can connect this to investing. I can connect many things in life to investing. And this is a lesson that hopefully you can get from this story. There are people in this world that care nothing about other people and look out for themselves. All this guy was thinking about is vet bills and dealing with the police, with his dog and stuff like that. And to heck with me, heck with worrying about the dog, he's just going to leave and get away with it. Well, there's many people that treat your money the same. And if you're not totally on guard at all times with your investments, this will happen to you. And you'll have, just like I'm standing there, what do I do? Right? There's no way I could have left AJ to run and get his license plate number or anything like that. You're going to get away with it. If people get into your accounts, get your accounts offline and wire money out, what are you going to do? How are you going to get it back? So I am ultra prudent about security on my investments. It worries me to no end when I hear people, oh yeah, I mean, they pull out their computers and they got all their stuff, their financial life sitting there, and they're doing transactions and they're doing all this kind of stuff all the time. And it's like, don't they understand? There's hackers that can hack into the Pentagon. You think you have computers that are safer? I mean, seriously. So you want to minimize your footprint of your financial life as much as possible. And in today's day and age, you know, it's almost impossible not to have some footprint out there, but you need to have safeguards. And one of those is make sure you have passwords on your account. And at Vanguard, you know, they have one of the highest forms of passwords, which is, and I don't know if Fidelity or T. Roy Price has it, but it's called voice recognition technology. So your password to your account, in order to get into it, is your voice. But however, you know, people are doing this stuff online. So what I do is, with my accounts, is I have an order that no transactions can be done on my account electronically. In other words, you cannot make any changes to my investments, you cannot make withdrawals from my investments unless it's done over the phone and I'm talking to the person. So if, God forbid, someone did get my account numbers and somehow was able to know my Social Security number and all that other data and somehow crack my password, which is, you know, pretty hard, but, you know, far-fetched, but, you know, I never imagined a guy would, you know, this would happen this morning. You know, just so that gives me the peace of mind that someone can't get in there and just wire my money to some other bank. You know what I mean? So be vigilant with your investments. You know, I'm trusting of other people, but when it comes to money, never forget, there is nothing in this world that corrupts morality more than money. It's just the way it is. And don't forget it. And you got financial, it shocked me one time. I was helping a young lady. She had investments with a firm, and she wanted to do an IRA transfer and didn't know how to do that. So I told her I would help her. And she came over to my house, and we were doing the forms, and you needed her account numbers. And we looked at her account statements, and I could not find her account number. I mean, it was really weird. I mean, you'd think it would be one of the most obvious things on there. And we couldn't do it unless we had her account number. And so I said, well, maybe you could call the office and get the account number. So she gets on the phone, calls her financial guy's account. A secretary answers. She says, I am so-so, and I would like to know my account number of my IRA. And the lady gave it to her. And I was like, what did I just hear? I mean, she didn't ask for your Social Security number, your birth date, she didn't ask for a password, she didn't ask for any identification other than, oh, I'm so-and-so, and I'd like to have my account number. I mean, that shocked me. So be vigilant when it comes to your accounts. So that's my advice for today. And by the way, AJ will get better. I'm sure he'll be back out there, and just going to have to give him some good rest. All right, today's lesson. So, we are in a bear market. I mean, officially, I said like on last week's lesson. I mean, we passed the 20%. There's different metrics terms we give to the market action. A bull market is when you have two consecutive quarters of growth. A bear market or a correction is when you have the market goes down 10% or more, to 10% to 20%. Normal volatility is like the market goes down maybe 0 to 10%. That's just normal volatility, day-to-day stuff. A bear market is when you pass the 20% down, and we're in that. And it's interesting because all bear markets are different. Normally, a bear market is associated with a recession, and we're not in a recession officially. So it's going to be interesting to see how far we go down from here if we do have a recession. And I advocated in this class, and it's why I always talk about asset allocation. It's so important, especially when does a bear market affect you financially the most? And that is when you're near or in retirement, because you're living on your investments or close to living on your investments. You're at that state when you're going to be drawing from those investments. When you're in your 20s and 30s and 40s, you have an enormous amount of capital, but it's human capital. Your human capital is your youth, your energy, your talents, which you can utilize to make ends meet. But as you get older, and it's not that you lose all your human capital, but the plan should be you use your human capital, and while you still got some, you can use it for other stuff like fun stuff, and that's what you're working for. And living on your portfolio, you're probably in a position when you're drawing from it, and when you're drawing from it and spending it, you're never going to make that back. And so when you have bear markets, and your assets go down 20% or more, and you're drawing from it, it can be quite devastating to your long-term financial health. So, as I have said many times in this class, the best way to handle a bear market is be prepared for a bear market beforehand, and that is your asset allocation. Because this whole deal about timing it and when to get in and when to get out is impossible. It is people, if someone does it, it's luck. You can have all the skill in the world, but no one really knows exactly when those turning points are. And as I said in last week's class, there's just certain days that if you miss, has a huge effect on your total return. And I ran into this on Yahoo Finance, and it's a chart that shows about the S&P 500, which is a good measure of the stock market. And when it goes down 20% from its record high, and it says, what is the average return 6 months later? And the average return is a plus 4%. And that is about 60% of the time. After just 6 months after it hits the thing, it has a return, it has a recovery. After 1 year, the average return is around 15%, and that happens about 70% of the time. After 2 years, it's about 26%, and that happens about 70% of the time. And when you have 3 years, the average return is around 29%, and that happens almost 90% of the time. So you're looking at 3-year windows here, where really, but when does it turn around? If we go back to the bear market of 2000, that was particularly grueling because it was like 3 years before it really started turning around. Everyone is different. I don't know about this one. I don't foresee this all of a sudden turning around, even though we've had some really good days, I guess, earlier this week. But is this the end of it? Is this a return? No one ever knows. And so the point of this is that history says that if you give yourself 3 to 5 years, there's a really good chance that you're going to have recovered. But if you're like 65 years old or 75 years old and you're drawing from your retirement, and these years are down 20% or more, it can be quite devastating to your long-term financial future. So having an asset allocation that is allocated roughly 50% in bonds, and especially as we talked about last week, You can protect yourself with really, really short-term bonds, ultra short-term, or even money market bonds right now. You can be drawing from that and letting that stock market, not touching it. That's what asset allocation. So I have been prepared for this bear market before we even had a bear market. And I'm prepared for the next bull market because my asset allocation is roughly 50-50, and statistics show I will do quite well on the upside when the market turns around. In fact, the good news that I see is when this does turn around, it could be a crackerjack recovery in that bonds are down so cheap right now that when we start turning around on the economy, moving to, interest rates will be higher, and turning to longer term bonds will give you a tremendous return, because the metrics with bonds will change so much. Interest rates will start falling, interest rates will start falling to some degree as the economy gets better. So anyway, you'll have a combination of really good returns in the stock market and really good returns in bonds. So, and having that 50-50 mix will be really good, because you could potentially get 10 to 15% in bonds and 10 to 15% on the stock side, which is really, really good. Okay, so we covered the different kinds of what we call the definitions of what the market is doing. Now the question is, why is it doing what it's doing? And that's what this lesson is really about. So it's really interesting, is John Bogle, in one of his books, it's very simple math to identify what the return of the stock market is on any given year and why it happens. It's exceedingly simple. It's amazing. Well, first of all, this is an example. Basically what you're doing is you take the dividend yield of the stock market, and then you take the growth in earnings of the companies in the stock market, and then you take the increase or decrease in the willingness of investors to pay for those earnings, and you get the return of the stock market every year. So this is a hypothetical example of a tremendous bull market. So let's try to explain the tremendous bull market of 1982 to 2000. And it can be explained this way. You had the initial dividend yield of 5.8% over that time period. You had a growth in earnings of 6.8%. And you had an increase in what's called the price to earnings ratio of the stock market of 5.7, and it gave you an average return of 18.3%. That explains the average return over that tremendous bear market. So every year what you can do is you can look at the dividend yield of the stock market, the growth or recession of earnings of the companies of the stock market, usually measured by the companies in the S&P 500, and then this, PE ratio. So what is the PE ratio? That's a terminology that investors should know, and you as an investor should know, especially if you're using the approach to the market that I do. I use the total stock market index fund to represent equities. And so what am I paying for the earnings of those companies? That's important to know, because that really tells me, if I know the historical range of PE ratios, if the market is overvalued, it's fairly valued, or it's undervalued. So what is PE ratio, and how do you calculate it out? It's really quite simple. And this is a tool that many stock people use to analyze individual companies. But the price to earnings ratio is you take the price of a company, so the share price of a company, let's say it's $60 a share, and that company has earnings of $3 per share. So you divide that out, and you have a PE ratio of 20 times earnings, meaning investors are paying $20 for each $1 of earnings. So with the stock market, what you can do is you can look up the earnings of the S&P 500 companies. So you take those 500 companies and you add them together and you find their earnings and divide it by the 500 and you find the PE ratio of the S&P 500. So if you wanted to do that, simple method would be type in SPY at Yahoo Finance or any of the other financial engines, and that'll give you the ticker symbol for the ETF of the S&P 500. And then you should see a column that says PE ratio. And then you have the PE ratio of the stock market. So what you see historically happen during, let's take it, because the stock market is a microcosm of all the individual companies. So you can use an individual company to get the rationale of valuation. So let's put yourself as a person out there and you are going to purchase a business. You're not just buying stock in a business, but you're actually interested in buying a business. So you go through the books and you find that that business has lost money for the last 10 years. Now, would you pay a premium for that business? You probably might not even buy it, right? It kind of looks like a loser. But then you look at things like location, and maybe you could do something different. You saw some potential, but even if you saw that potential, the fact that that company was losing money for the last 10 years, you would ask for a bargain on that, wouldn't you? In other words, you wouldn't price that very high. Now, if you looked at that company and you saw it had pretty steady earnings, but they didn't change much, but they were consistent, they did well through all economic cycles, then you would probably pay a fair price for that company, right? No, then you look at a company and you see that it's had, the last 5 years, it's increased earnings 15% a year. And then you looked at their business and you saw, wow, there's potential to have this going on indefinitely for some time. You would probably have to pay a premium for it. In other words, you pay more for each dollar of earnings because of the potential there. It is the same thing with the stock market. And so if you look at the stock market right now and you say to yourself, what is the potential for explosive earnings from here? I mean, we have inflation, we have interest rates going up, we have a war going on in the Ukraine, we have oil prices that are going up, and we have all these things going on, which, is that a recipe for strong economic growth? No, is it? And so you see investors not willing to pay so much for those earnings that the companies have right now. And so even if we're not in a recession right now, and that explains why we have a bear market, and we have a bear market even though we're not in a recession. Because when investors are looking at those earnings and saying, oh, those are the earnings that we had, but looking forward, what is the future? What is the market pricing for the next 6 months to a year? And it's telling us that doesn't see strong earnings, and so it's discounting the market. The market always discounts itself looking to the future, or it pays a premium if it sees a potential for recovery or growth. So we will enter the next bull market probably when many people think we're still in a recession, because there's things that are taking place in the economy that will set the stage for stronger economic growth. And that's what this lesson's about, to help you understand how these chain reactions happen and the things to watch. And it's not complicated. You don't have to be like, I remember back in the day there was a Federal Reserve chairman named Alan Greenspan. And famously, I would be watching TV and they would be talking about this image of Alan Greenspan. He worked 24 hours a day. In fact, Word has it that he used to lay in the bathtub and read economic data. Now, there, if you've never seen Alan Greenspan, you know what there is an image you don't want to play in your mind too much. So this lesson is not about crunching all this data. It's really really basic stuff. Like when you walk into a bank or you look at a bank, what are the interest rates that you can get on a 1-year or 5-year CD? Because that gives you really good insights into what's going on with interest rates. You know what I mean? You don't have to go and check the treasuries and all that kind of stuff, because really those are good barometers. And then things like the mortgage rate. What's happening with the mortgage rates? You know, if mortgage rates are going way, way, way down, okay, then there must be a lot of demand for houses. So under what economic conditions is there strong demand for houses? Usually when there's a lot of people working and can afford houses, right? It's things like this that help you get insight to the health of the economy. So we'll be talking about those things. Okay, but before I do that, because in this aspect of the stock market, if you go back to the last time we were in something of a predicament economically like this, we're talking about the 1970s and early 80s, when we had what's called stagflation. And stagflation was, we actually had a growing economy, but because inflation was so strong, the real economic growth was not there. In other words, inflation was eating away the earnings of companies, and inflation was eating away the buying power of people. So they were getting pay raises, but they weren't getting pay raises that were keeping up with inflation. So, you know, if you have inflation at 8% and you get a 5% pay raise, which is a really good pay raise, you actually can buy 3% less. I mean, that's stagflation. And so the last time we were in some situation like that was, I said, the 1970s. And if you look at the components that we talked about here, is you had, the companies were paying dividends. I don't know what the dividend rate was, and we had growth in companies' earnings, but they weren't real growth because inflation was eating away. But what you had was this collapse of willingness to pay for these earnings. So you go back to the 1970s, and I have a chart which I'll show later. I hope I brought it with me. But it shows going back into the 1970s, and the PE ratio of the stock market was down to 7 times earnings. I mean, if you look at the last, basically since the 1990s, you haven't seen the price-to-earnings ratio of the stock market get down much below 15 or 16 times earnings. Most of the time it's around 20 times earnings, because people have been so willing to pay for the growth of the earnings of companies. So psychologically, the psychological makeup of investors has an influence on PE ratios. And so to address that, I have what's called the stock market's emotional cycles. Let's see, where did I get this from? It's from indexuniverse.com. It was an article I saw on there. When I saw this, I thought, my goodness, this is brilliant, because it really does explain so much, these cycles. So what are the emotional cycles of the stock market? First of all, when you're coming out of a bear market and you start having some good returns, investors become optimistic, And as we progress through a bear market and they're doing better and better, people start getting excited. That's what happens. You get excited. It's fun to look at, and you talk to your friends about how well your investments are doing. And then, maybe you have a crackerjack year, where it just does really, really well. Then you are thrilled, because you just went through a bear market, and now you're seeing how well you're doing. You're absolutely thrilled. And it keeps going. It keeps going up. And eventually you reach this level in a bull market of euphoria. Euphoria is usually identified by terms like, oh, don't worry about a bear market because this is the new age. And how do you make $1 million in 2 days? And the millionaire next door, what did he do? He bought 2 stocks. You want to know the secret? Call me up. This is what you see. You see everybody is out of the woodwork telling you to get into the stock market. You see behavior like we had back in the late 1990s. I saw this and was one of the motivations to do this class, where people were going and getting home equity loans so that they could put that money into the stock market. That's simply idiotic behavior. It's crazy behavior. They don't, because of the risk of it. But people do that when they are not thinking. Markets get euphoric. And it's during times of euphoric you identify it also statistically wise, as you see in crazy price to earnings ratios that people are paying anything. If you think back to the 1990s and what you saw people paying for things like Lucent Technology and Cisco Systems, and you looked at their PE ratios, there were companies that went from $10 a share to $300 a share that were losing money, had no sight of making money, but people were just throwing money at it. And if you look at the last 10 years, what are people throwing money at? It's like the cryptocurrencies. Just euphoric behavior. Just cryptocurrency, what 10 years ago or whatever it came out was like $100, and then it went to like $25,000. That's just euphoric behavior. It's not based on reality. Okay, then you start entering a bear market, or what we call the cycle we're in kind of right now. And I think we're kind of in the first phases of it. People are getting anxious. We're down 20%. People are starting to feel uneasy. They're not panicking yet. Most people you don't see, and usually it shows up in the form of volume on the stock market and huge swings, 2, 3, 4 point swings in the stock market. You're not seeing too much of that. It's because people are anxious. The next phase of an emotional phase of a bear market is denial. They call up their financial advisor and don't worry about it. In fact, a really good idea now is to put more money in right now. Denial of the fact that this is a bear market and there's a reason for it. I am telling you right now that the market is trading fairly right now. It should not be priced at 20 times earnings or 25 times earnings. And these rallies that we've had the last couple days, I'm not buying that this is the end of it. And boy, I know you're probably reduces some of your anxiety to see a 700 and 800 point day, but you know what? That's the normal stuff that's going on. Bear markets, they just don't go straight down and then straight back up. There's all kinds of stuff that goes on. Okay, eventually we're going to get the place where you have fear. And not all bear markets are the same. Sometimes they turn around. Sometimes they're really brief bears. And they happen so fast that people don't get the state of fear. But the longer this particular bear market draws out, the people who are retired, the people who are living on their portfolio that haven't done the right thing as far as diversification and asset allocation and stuff like that, they're going to be looking at their statements and they're going to start getting scared. They're going to be worrying about they're not going to be able to live their life out without running out of money because they haven't been prepared for this. And that is one. There's 2 emotions in investing that you must stay away from and negate as much as possible. One is greed and the other is fear, making investment decisions based on fear. And when you get to that, you'll see much more volatility. You'll see people really getting scared about their financial life. Then, if it keeps going down and things don't change, we enter desperation. And with each progression down in the emotional cycle, the market gets more and more volatile and more depressing emotionally. Eventually, you reach panic. And panic, you will see people calling up their company's 401ks. Get me out. You'll see young people. Oh, I can't take this. I'm taking this out. I'm moving all the cash. You'll see all kinds of behavior, panic behavior, getting out at all costs. It's the end of the world. And when you pass panic, you reach capitulation. Capitulation is when many people just throw in the towel, completely sell everything out, get into safe cash, and things like that. And finally, despondency, where you just give up. I'm never going to put money in the stock market. And actually, when you get to capitulation and despondency, that is actually the point of maximum opportunity in any investment cycle. In other words, as the famous Wall Street people love to say, when there's blood on the street, you got to be out there and buy. That's my pep talk for you. But anyway, it's hard to get optimistic and get excited about buying when you see, just panic. You see people, it's just, and I've been through so many, and you see so many times this emotional cycle payout. And then you have a period of depression. And then you have eventually hope. Things start turning around. And then after hope comes relief, because the market starts the economy starts, people growing, jobs, layoffs start stopping. In fact, you start to get positive job growth, and then you're back to optimism, and we start all over again. And we've been, it's just, with all the tremendous financial levers we have, the central bank and all these different things, and the government, willingness to spend money like drunken sailors to make sure people have money, even in recessions when they get laid off, we have these economic cycles. And you say, well, why is that? It's because the fundamental economy is built on human beings. And human beings have a propensity to do really dumb things with money. And when times are good, it's called recency bias. They behave like it's going to last forever. And when times are bad, it's like it's the end of the world and it's never going to get better. And their behavior reflects on their spending and their saving habits. And those things reflect on the economy. We're never going to be able to even out and have a stock market or an economy that just trips along, and we never have these roadblocks. And what's really interesting about this particular cycle is we have some X factors thrown in besides the economic things I've been talking about. This war in Ukraine is a major concern, because it's disrupting energy. It's disrupting the global economy. And it's creating divisiveness between us and China and India and all this kind of stuff. And it's like we are in a global economy. There's an interdependency to the world right now. If you're going to have a world where people throughout the world prosper. And so is this idea of the fortress, the United States, we can do it all. Let's build everything here. Let's do this. That's a political sales pitch, but it's not reality. We just can't do that. We don't have the resources. We don't have the resources to do that. So we need the global economy to work, and so forth. And this particular economic cycle is affected by those X factors. And now we've had this major hurricane. And the ironic thing about the hurricane, as devastating it is, and I'm not placating the pain and suffering it's caused, but it actually probably will help boost the economy, because you have to rebuild everything. So what's going to happen is this money that insurance companies have locked up, If you're investing in insurance companies, maybe not so good. But if you're investing in building companies and appliance companies and car companies, and all these things have to be replaced, if you look at what happened with Katrina, I mean, it created a certain amount of economic expansion. You know what I mean? So that's different than this war in Ukraine. So those are things that you can't really price so much. So what you do is you pay attention to the things you can price and you can get a handle on. And that's the economic things that are going on. And those things basically are, I call it like the big three, or the big four. You have the interaction of inflation, and then you have the interest rates. What are interest rates doing in response to inflation? Then you have the Federal Reserve and the policy that they are doing to maintain economic growth, and also to what they're doing with inflation. And then finally, the price-to-earnings ratio of the stock market. And there's sub-indicators that you can kind of pay attention to, and one of them is job growth. I mean, you will know we're in a recession when all of a sudden you're seeing job numbers going from hundreds of thousands of jobs being created each month to no jobs being created. In fact, loss of jobs, that is going to be the indication, yeah, we're finally there. We're in a recession. That's kind of the thing. And then housing sales are important because houses are a huge part of our economy. Productivity, GDP growth, auto sales, and wage growth. I'll talk about all this stuff and how it interacts. But the big one is, and when you're talking about any economic system and the health of any economic system, it goes back to inflation. So to many people, inflation is like a dirty word, but it's not. In fact, inflation is an important part of any healthy economic system. So what is inflation? Inflation is the increase of costs of goods and services. And I've done this experiment. It's so interesting. Because I've said for 20 years, I went to the high schools and did personal finance classes, and all these kids have had some economics and stuff like that. And whenever I talk to them, what is inflation? I would say 99% of the time, they always give me the wrong answer. In fact, it got to the point where I would pull out $10 bills and $20 bills, and I would say, any student who gives me the definition of what inflation is, I will give them this $20 bill, willingly. And of course, then that gets their interest, and their hands all go up because they know the answer. They want that $20 bills. And so, what do you think the answer is? The answer, predominantly, they would always give me is, well, that's when the value of money decreases. For some reason, that sticks in their head. I mean, and the best way I can explain that is, that's like exercise. When you exercise, you sweat, don't you? So, is exercise sweating? It's caused by exercise, isn't it? And devaluation of money is caused by inflation. It isn't what inflation is. So sink it through your head. I don't know, they don't have that show on anymore. So if you're ever driving around in New York in a cash cab and that Ben Bailey asks you, like, what is inflation? Give me the definition. You can say, it's the increased cost of goods and services. And Ben will say, that's worth 300. So it's the increased cost of goods and services. And the byproduct of inflation, obviously, is it decreases the value of your spending power. So how do you measure it? There's a couple different ways. We have what's called the predominant one that most investors talk about. It's called the CPI, Consumer Price Index. So if you're really interested in this, you can Google it and look it up, and you can actually look at it. The government has agencies all around the country. And what they do is they have this whole basket of thousands and thousands and thousands of items. And there's people that go out there and look at the price of these each month and then add them up. And then they report that total back to the Federal Reserve. And it is all over the place. And then the they get a grand total, and they look from one month to the other and see how much did it increase or decrease. It's a consumer price index. It includes, and a predominant thing in the consumer price index is like food and energy. And one of the reasons why we have such big inflation is because everybody needs food and energy, right? And so it's a big part of what we spend, and it's very, very volatile. And so the consumer price index measures thousands of things, but kind of those dominate. But if you really want to look at the health of inflation, I kind of bypass food and energy, even though it's a big part of what we spend. Because I look at what is all the other stuff doing? And why do I do that? That's what the Federal Reserve does. They call it the core CPI. And the core CPI is the CPI minus food and energy. Because if you want to see if inflation is really systemic in the economy and is really, really caused by the primary source of inflation, you see it throughout everything, not just food and energy. So what do I mean by systemic? What is the major cause of inflation? Okay, so people think, well, like, if you look at food and energy, weather can have a huge effect on both food and energy, can it? Okay? But if you look at the goods and services, because there's so many things that you buy, isn't there? There's so many services and goods you buy. So if you go to like Quick Trip, what do you think the biggest expense of running a Quick Trip is? It's really labor, isn't it? The fun, especially in our economy, because a huge part of our economy is the service sector. So if you go to a dentist, what is the biggest expense to that dentist of running their business? It's paying the hygienist. It's the pay for the labor, isn't it? So when you see the core CPI going up at rapid rates, it usually has to do with the fact that the cost of labor has accelerated significantly. And you have seen a major acceleration since the pandemic in the cost of labor in this country, even down to the lowest, the minimum wage. Nobody's working for $7.25 right now anymore, isn't it? Kind of the minimum wage now is what? $15 an hour. So what's happened is, in a matter of a year or two, the floor, what we call the floor for wages, has gone from the $7 range to the $15 range. Now, what do you think happened to the people that were making $15, and now all of a sudden the newbie is making $15? What do you think? Are they showing up for work to get $15 an hour if they have 5 years experience? They're saying like, well, if you want to keep me around, I want 25, right? So it's great that the lower end of the scale is getting big pay raises, but you got to push it up throughout the system. Otherwise, those people are going to go someplace where they can get it, because there's a huge demand for skilled labor, and people have the ability to do that. So that's one of the things you need to understand, and when you look at when does inflation become a problem, it's when the inflation rate of wages exceeds what our economy can handle. And that's why I said inflation is good as long as it's healthy inflation, because it means people are getting pay raises. But when people get unsustainable pay raises, then what do people do with the money? What's the savings rate in this country? Especially on the low end of the wage scale. They go out and spend it, right? And when everybody's spending all this new money and it's pouring in on the demand side, and now you have a shortage of labor to produce those goods and services, what does economics say when there's an overabundance of demand and a limitation of supply? what happens to happen to the price? It has to go up. It's as simple as that. So please, you know, I'm not anti-pay raises, but an economy has to be in balance. And every economy has the ability to grow at a certain rate. We are now a mature economy. We cannot sustain 8-9% growth rates, and because we don't have the skilled labor for it. And so our standard of living is already so high. So what you need is a sustainable inflation rate based on a sustainable increase in wages. And the ideal thing is to have like a core rate, the Federal Reserve says, around 2%. A CPI running 3.5%. And then people getting pay raises around 3% or a little bit better. And that can be sustainable. So as I said, inflation is good because it means people are getting pay raises. But when you have inflation that's out of control and too good, it creates a problem. Yes?
Is the productivity rate somehow part
Okay,
of that?
okay, can I ask you to, his answer, he's getting into productivity, and you'd be like Ed McMahon setting up a joke I'm not going to tell for another 10 minutes. So I'll get to that, okay? You're my setup man. I'll get to productivity because it is an important part of this. But we need...
They have to be related.
Oh, yes, they are. So why does inflation matter? Well, because inflation, it devalues corporate profits and it devalues wages. So when I said you can measure the return to the stock market every year, and I said, let's say we had growth rates of 5.6%. If you have inflation of 5%, what is the real growth rate of those earnings? 0.6. Are you willing to pay $20 for every dollar of earnings if the growth rate is only less than 1%? Because you always talk about the real earnings. It devalues those earnings. It encourages forward consumption. I was just listening on the radio the other day. While I'm walking AJ, I always have Bob and Tom on. Get a lot of good information on Bob and Tom. And anyway, Christy Lee was giving the news for the day. And shockingly, we're going to have a shortage this year for the baking season. What's going to be short? Butter. Evidently, the cows have gone on strike. No, evidently, because of a shortage of labor or whatever, there's going to be a shortage of butter. So what are retailers finding happening on the shelves currently? Because the shortage isn't happened yet, but we always have a seasonally adjusted increase in the consumption of butter. And so what companies like to do is buy ahead so that they have stocks for before the demand gets there. They can't get it. So what's happening? Everybody's out buying the butter now and forward consuming. And what does that do? It creates even more of a shortage. And what do you think is going to happen to the price of butter? I mean, there's going to be such a shortage of it, and you gotta have butter to bake those brownies or whatever, you know, because what is margarine, right? You gotta have the real thing. It's Christmas, for gosh sakes. Santa doesn't eat those cookies with Crisco. Okay, so all this forward consumption is just going to drive the price of butter up. So go home on the way home, stop it, whatever, and get your butter before it goes up even more. Yeah, it creates this forward consumption, which even exacerbates the inflation problem. It penalizes investment lending. In other words, we're talking about bonds here. If you're out there and buying a bond or investing in these bond funds, which is lending money to these corporations, you're seeing 10% negative returns right now because interest rates are rising in response to the inflation. And even if you're getting 4 or 5% interest and inflation is 8%, how are you coming out ahead? You know, it's penalizing you for being a bond investor. It rewards debt because people who are borrowing right now are paying it back in depreciated dollars. It rewards those people that were smart enough to get a 3% loan on a house when, you know, back before interest rates rose. It decreases purchasing power. Interesting chart here. Go back to 1906. If you had 46 cents, in 2006, I'd have bought you $10 worth of stuff. If you had 50 bucks, it's equivalent of about $1,000. And if you had $46,000 in your 401k back in 1906, that was equivalent today to having $1 million in your 401k. And in fact, that's 2006, so that's changed significantly since the last almost 20 years. You know, the bite of inflation, 1962, 2006 prices. I was a child in 1962. I remember going down to the corner store and getting my Hershey bar. I loved Hershey bars. They were 5 cents. And they were that big. They had almonds in them like that. They're awesome, you know? So, I mean, what are Hershey bars today? $1.25, something like that? The New York Times, back when people read newspapers, back in 1962, 5 cents for a New York Times. I mean, what does the New York Times cost now? A postage stamp was 4 cents. I mean, we've done pretty good there because it's only 50 cents now. So, I mean, still, you know, you can afford it. A gallon of gas, 31 cents a gallon. Yes. I got my driver's license in 1960-something or other there. I remember I couldn't wait. I saved up my money and I bought that little Honda 50 because all the cool people had Honda 50s. We had a whole gang of my friends that had little Honda 50s. It had a gas tank about this big on it. You'd go in there and they even pumped the gas for you. I'd drive in and fill her up. And that would be 35 cents, sir. Put the cap down, drive off. Oh, bad. But, you know, what is gas now? A Chevrolet, the average Chevrolet, $2,500. What is it now? A double hamburger, 28 cents. My favorite story there, so I know some of the people have taken this class, but I have to share this story for the people that haven't heard this story because it's one of my favorite childhood memories. I'm the oldest of 5 children. My parents didn't have much money. And I grew up in the Catholic faith, and we went to St. Peter's here in Oshkosh. And so it was every Sunday. We would pile in the car as a family. We would go off to Mass, probably, it was like maybe the 8 o'clock Mass or 9 o'clock Mass, something like that. And if we behaved in church, and this was the incentive to behaving good, my dad would go to Henry's Hamburgers on Main Street. So if you never heard of Henry's, it was a chain of hamburger joints, kind of like a McDonald's or a Hardee's, and it was on Main Street here in Oshkosh. And on Sundays, they had a special in which you could get 7 hamburgers for $1. 7 hamburgers for $1. And they were like this big too. The buns were this big. The hamburger in there like that. But anyway, not having much money, we never went out for restaurants. We never had fast food. We never had pop. We never had any of that stuff. So the idea of actually having a fast food hamburger was beyond. I mean, throw the steaks away, throw all this, because my parents would go out and like buy half a cow, so we had this prime cuts of meat and all this kind of stuff. I mean, they fed us really great, but there was nothing like a Henry's hamburger. And this was beyond good. And being the oldest, if we were good, my dad would send me into Henry's Hamburger. And he would give me $3. And I would walk up to the counter with my $3. I could barely look over and I would say, 21 hamburgers, please. Guys would look out, what bus is here? It's only the Kemps. and so I would come out there and I'd have all these bags of hamburgers. And Henry's was, it was like yesterday. Henry's was like 5 miles we had to drive before we got home. Sitting in the car with the smell of those hamburgers, the drool coming out of our mouths of all my brothers and sisters, it was ridiculous. I think my mom and dad had to clean out the car just with all the drool that was on. We'd finally get home and we would just tear into those hamburgers and we'd just wipe them all out. There would be nothing left after about 10 minutes. It was amazing. 7 hamburgers for $1. We will never see that again. But fond memories. Anyway, inflation has done that to us. Kids nowadays just don't understand. Okay, so another way of looking at inflation and purchasing power. If you have a 2% inflation rate, it decreases the value of your money. It cuts it in half. It takes about 24 years. If you have, this is the normal, 2 to 3%. That's what we've been experiencing pretty much in the golden age of our economy. Really, since the 1990s, we've had a couple of blips in there, but mostly it's been 2 to 3. Meaning your investments and so forth, before they would decrease by 50%, it was 18 to 20 years. If inflation ticks up to 4 and 5%, you're talking about every 12 years, it decreases the value in half. If it's running at 6%, and we're running at what, 8 and 9 right now? If we had a sustained 6% inflation, it would take just 11 years, and if you had $1 million portfolio, it'd only buy roughly $500,000 or $600,000 worth of stuff in today's dollars. So inflation is a major, major issue to health of any economy, thus the health of you as an investor in that economy, and you got to get it under control. And so how do we get it under control? Okay, well, the primary weapon we have is the Federal Reserve. But before I talk about that, we got to talk about productivity, because I heard that discussed here. Productivity is one of those. If you look at, as I said, I called it the golden age for us in this country when we talk about inflation, is since the 1990s, even the 1980s. Think of what's happened to technology in our lives and how it's increased our ability to produce goods and services. I can't quote it off my head, but I heard a statistic about the accumulation of information. And it's like in like 1 year, we've accumulated more information than the previous 10,000 years of human history. It's crazy. Just information. And information is really important in productivity, because if you have information, you can solve problems. If you look at the technology to access that information, you think of the internet, you think of the wireless communications, you think of the computers and all of this stuff. We've had this explosion in the ability of a human being to produce a good and service. And this explosion has allowed us, an individual, to produce so much more. And the more skilled you are, the more you produce. And when you're in that kind of an environment where you have a tremendous explosion of productivity, a person can get a pay raise, and it can offset that pay raise. In other words, I don't know if I brought along that chart. I'm jumping ahead here. Yeah, I got it right here. I call it my gizmo chart, because you all buy gizmos, right? Yeah, I mean, better get out there now, because there might be a shortage of them. But anyway, right now there's not. But let's take gizmos and talk about explaining productivity. So let's say a company has 10 employees and they produce 1,000 gizmos a day. Now, the owner of that particular business has broken it down and look at labor costs, look at all the benefits, and raw material costs and insurance, all this kind of stuff. And it breaks down, it costs him $5 to produce a gizmo. And so maybe he sells the gizmos then for $7 or $6. All right? Now, let's say he brings in a new piece of equipment and trains these 10 employees so they become even more skilled than they were before. And now those 10 employees can produce 1,200 gizmos a day. So they're working the same number of hours, but they've increased their productivity by 20%. That's 200 more a day. So the cost goes down 20%. Reduces the cost to $4 a unit. So if he is a smart employer, he looks at, okay, I'm producing 1,200 units a day. I'm saving $1 per unit. That's $1,200 I'm making more a day. If he's a smart employee, what he's going to do is he's going to look at his 10 employees and say, I want to reward them for the fact that they're more productive. So maybe I'm going to keep an extra $200 of the $1,200, but I'm going to divide the $1,000 I'm making a day and give each of my employees a raise to compensate for their productivity. Now you have a perfect scenario. You have the consumers of the gizmos having the price remain the same, the quality the same. You have 10 really happy employees who got a big pay raise for producing more. And you have an owner that had just increased his profits by $2 per gizmo too. So everybody's happy and the economy hums along. That is a perfect scenario. So how come we're having all these problems? Why don't we just produce more, be more productive? Because it doesn't work that way. You can't just like, well, I mean, you can make a person more productive by just, cracking the whip and whipping them. But how long does that work, right? A human being can only work so hard and so long before they become non-productive. That's why Aaron Jones doesn't run every play for the Packers. You got A.J. Dillon now, and now he's even more productive because he's not getting banged up so much. You know what I mean? So you can increase productivity, but a lot of it has to do with education, and it has to do with a society that values the increase in sophistication of technology and the investment in the mechanisms that create productivity. And that's where the government can be a great hand in the economy, is the money they spend on education and encouraging companies for productivities, giving them tax breaks for investing in technology that makes people more productive and training people and stuff like that. So when people scream about, oh, those handouts to those evil corporations, actually, done efficiently, it's good for everyone when the government responds in good ways and can be a conduit to a more productive and educated. The more educated we are, the more productive we're going to be. Everybody's going to be much more happier. Okay? So productivity is one of the elixirs that helps to offset inflation. But of course, as I said, there's a limitation to the ability to increase productivity. So sometimes you just have to put the hammer down. Sometimes you just have to make the economy slow down so that the supply of labor, supply of raw materials, and all this stuff comes in line. And so how can we do that? Okay, so if you go back to the history of our country before like the turn of the century, most of the decisions having to do with money supply, cost of borrowing, things like that, was basically in the hands of the big bankers of our country. And we had wild swings of our economy. We had not just recessions, but depressions and booms and busts and everything else. And finally, the government said, we need to do something about that. we need to create a central bank. And so the politicians got together and created a central bank for the United States. This is not a government bank. It's independent. It's independent in that it has the power to do things without the Congress saying, this is what you have to do. They make the decisions. In other words, Congress and the president vest them with this power to have mechanisms available to influence the economy and make it healthy. They're mandated with two things: to try to maintain economic growth, but also to maintain a healthy inflation environment, because you can't have one without the other. Okay? So anyway, the Congress gave them immense powers. And we have a Federal Reserve chairman that's nominated by the president, has a term, I believe, of 6 years. And then we have Federal Reserve banks all around the country. And now the mint prints the money. So the government can print all the money they want, but that money doesn't get released into the economic system unless the Federal Reserve releases it. So the Federal Reserve is a central bank that controls the money supply. So let's look at the law of supply and demand. If you have a growing economy needs more money. In other words, if everybody's out there and businesses are borrowing and people are borrowing money, and there's not the money there to borrow because all that money's already been borrowed out, then the Federal Reserve needs to release more money if they feel it healthy for the economy, so that that money is available for lending. And so what they do is they allow banks to borrow money from the government. So theoretically, all the money that you have is just borrowed. They're notes that are borrowed from the government. And the Federal Reserve has the power to set the interest rate on the issuance of new money into the economy. So when you hear the Federal Reserve meets every 6 weeks, and they at any time can make decisions, they have the power to do this. President Biden can't say to the Federal Reserve, oh man, you know, we got an election coming up, and you know what, we want to look good, so we want to keep this economy really, really growing, so why don't you cut rates instead of, and we have an inflation problem, and the Federal Reserve says, Mr. President, we can't be cutting rates to make you look good. We need to increase rates because we need to slow the economy down. No politician likes to see the economy slow down. Nobody gets elected saying, vote for me because I'm gonna lay people off. And I'm gonna slow the economy down. I'm gonna make the stock market go down. That's my platform. I mean, seriously, right? So anyway, because the Federal Reserve is independent, they can do this for the health of the economy. So in many ways, the Federal Reserve Chairman is probably, even in economic terms, much more even powerful than anyone else in the world because of the size of our economy. Very, very important person in your daily lives. He's affecting you right now. He will be affecting you in the future. Yet people don't pay much attention to the Federal Reserve. I do. It's huge in what I pay attention to and the health of the economy. And fortunately, since Paul Volcker, Ronald Reagan appointed, we had a huge inflation problem, I told you, in the 1970s. And let's see, yeah, I have a chart here. And back in 1982, 1980s, Paul Volcker came into office. And this was hugely, hugely unpopular. So many people are like, oh, it was a Reagan revolution. That Ronald Reagan, man, he really knew what he was doing. He was great for the economy. Ronald Reagan, I'm not political either way. You know, he was just a president, and so many times presidents get blamed for too much, and they get too much credit. If you really want to talk about the prosperity that we had in the 1980s and into the 90s, so much it was set because of the courage of Paul Volcker. And the precedent he set for Federal Reserve chairmen ever since. Because what Paul Volcker said is, I know, Mr. President, this is going to make you politically extremely unpopular, but I am going to have to hammer the economy. I'm not going to look for soft landings here. I'm going to have to hammer the economy. And there's going to be huge unemployment. There's going to be people wailing about this is terrible and screaming for your neck for appointing this maniac to the Federal Reserve. But he knew that he had to do this. Because so many times what we are as human beings in America is we're like little kids going trick-or-treating. We want the bag full, right? And when we get a chance to eat it, we'll eat the whole bag in one night. Sometimes we have to have it monitored. And this is what Paul Volcker did. And look at how he hammered the economy. He set the overnight lending rates for the Federal Reserve. In other words, if banks called up the Federal Reserve down in Chicago and said, you know what, we have a bunch of loans here, we need $10 million. Well, many times the Federal Reserve, if they want to make interest rates go, they stop releasing new money. But if they did, you can borrow money, but it's going to cost you 20%. What bank can borrow money at 20% and lend it out to somebody buying a home? It's insane, right? But that's what he did. And inflation, I don't have a chart to correspond with this, but inflation just tanked right after that and set the stage for this great bull market that we've had with some bear markets in between, but basically that one I showed you from 1982 to 2000. I don't know, because we were way down, and we were down to zero before. I don't know how high the Federal Reserve is going to have to go, but you know, they've said we're going to keep raising until we get our target. Yes?
Keep going slowly. You don't think they would do anything crazy like they did that?
Her question is, do you think he's going to be like crazy? Because they are, to many people, going crazy right now. Because normally when the Federal Reserve raises interest rates, the Federal Reserve doesn't like to shock markets, especially now with an election coming, because they don't want to have influence. They want to be apolitical. But the problem has become so serious that they've stepped out and they're raising at 75 basis points. And this is really going back to, you have to go way back 20-some years before we've even seen a 50-point basis rise. So they are going crazy, just not like Paul Volcker crazy. Pardon?
They're still so low in comparison.
Okay, we're getting there. And her comment was, we're still so low, and we are, and that's why the Federal Reserve said, the Federal Reserve knew the problem, and they could have went from 0 to maybe they'll get to 5%, and they could have done that in one move. They had the power to do that. What do you think that would have done to our economy? What do you think that would have done to people? That would have created chaos, wouldn't it? And so we have a bear market, but we're only down 20-some%. They're trying to do it, and remember, their mandate is to try to maintain a healthy economy and not create too much chaos. And hopefully they're able to do it, but they are determined. The Federal Reserve, they're interviewing one of them, right? They're going to keep going. They aren't done yet. And they're not tapering off on what they're doing because we need it. And to me, it's so refreshing in this country because when it comes to fiscal responsibility, we have the best government money can buy. You know what I mean? Because politicians know how to spend, but they do not know how to cut. They don't know how to say no. Because nobody hates babies. Nobody hates women. Nobody hates this. You know what I mean? It's so funny because everybody is spend for every different program, and no one talks about fiscal accountability. And that's where the Federal Reserve, and that's what gets us into problems with the inflation. You know, we talked with Lyndon Johnson, and he was part of it, that guns and butter policy. You know, you have to be fiscally responsible and understand when you've gone too much. You got to keep spending in line with the capacity of the economy to absorb that without creating excesses. And it's difficult for a politician to do that. Yes?
So do they print more money when they sell more treasury bonds? Or how do
Okay, that's a very interesting question. Okay, okay, let me explain that. Okay, because her question is, do they print more money when they have our treasuries? Okay, as I said, the Federal Reserve controls the money supply. So when politicians want to keep spending, they can't just like print money and then spend it. So one way they can get more money into the economy is sell treasury bills, because that's debt. So they can sell debt. So what the Federal Reserve was doing, because part of the problem we're in right now is the Federal Reserve is complicit in the problem we're in right now. Because when we had the pandemic, and even before that, the recession of 2008, so much damage was done to the economy that the Federal Reserve felt it needed to go to extreme measures to get the economy the stimulus it needs for healthy growth. And one of the ways is to allow the government to run up. I just saw where, I mean, I couldn't believe this, because I can remember when we were talking about debts in our country of $10 trillion. Do you know that we just passed 31 trillion in the blink of an eye? And that's just not Joe Biden, it's Donald Trump, it's the Bushes, it's Obama. It's like the trajectory has been, no matter what party's in power, like crazy. But how do they do that? And many people say, well, the government can just print money and then spend it. No. What they do is they release treasury bonds. So who is buying the treasury bonds? The Federal Reserve, in order to keep interest rates low, was actually buying those treasury bonds. A huge amount. I don't know, their books they have trillions of dollars. So they were complicit in putting more money into the economic system. And now they're stopping that and contracting it. So that's how that works. The government can't, or the president just can't say, pour more money in. The Federal Reserve has that power. And they realize that they went too far. And now they're pulling back. Okay, so when we talk about the range of inflation, I mean, this chart really has historically really a good one to pay attention to for you as an investor. When you have inflation that is in the 0 to up to like 3.5%, we're talking about the CPI. I mean, that is really, really positive for economic growth. That's healthy. That means we have a good balance of supply and demand for labor and raw materials. But when inflation ticks up to 4% and above, then we're starting to see the economy can't sustain a healthy economy with those inflation rates. And the CPI, the Federal Reserve targets around 2%. So you can see already in the indicators I look at for a healthy economy and a future growing economy, you can see that we're way in the red on the inflation side. And the Federal Reserve, using its powers, which is it controls the money supply and it regulates the interest or the cost of borrowing money, the Federal Reserve is doing its job right now. It's just behind the curve. So, and then we talk about the interest rates. There's actually two different interest rates. We have the interest rates of the Federal Reserve, which really affects short-term bonds. So the Federal Reserve is the overnight lending rate. So when you see the Federal Reserve raises interest rates 75 basis points, and then you look at your bank, usually a money market account the next day will correspond with the interest they pay, because that's very, very short. So right now the Federal Reserve is dramatically affecting short-term interest rates. Inflation affects, and the outlook of inflation really affects those treasury bills we're talking about that are auctioned. It affects corporate bonds that are issued. Those are set by auction. So when the government issues them or wants to issue them, the price of interest is set by the law of supply and demand. And so the marketplace sets the longer term and the intermediate term bonds. The Federal Reserve influences it, but they're much more powerful in influencing shorter term bonds. And really, when you talk about the grease that makes our economy function, short-term bonds are really important because corporations are, and even government is very, very dependent on being able to access cash and to pay bills and stuff like that, and borrowing money cheaply on the short end. And that's why right now it's a big problem for corporations and even government, the cost of borrowing for these short-term bonds, because they're like 4%, 5% on that level. So you're seeing those interest rates are really taking a bite right now. So raising interest rates reduces the ability of individuals to borrow money. It increases the costs of doing business. It increases taxes because the cost of running government increases. It discourages demand for stocks because of the available competitive yield for less risky assets like bonds. So we're not there yet. But eventually, as the bonds start yielding more and more. In fact, right now, I mean, you've got to be tempted to say, oh, gee, that bank just has a 5-year CD at 4%. You're getting crushed in the stock market. All of a sudden, that 4% guarantee for the next 4 years looks really good. So as this progresses and interest rates and they level out, if you see a bond fund that's paying 5 and 6% with very low risk, it becomes more and more competitive with money that go into the stock market, and so stocks become weaker because the money is going to bonds. You get it? So the Federal Reserve has this economic engine. So when you have monetary policy, when they raise interest rates, it fights inflation. When inflation increases, then interest rates have to go up to offset the inflation. So you're always facing what's called a risk premium. When you raise interest rates, it reduces the desire to take risk. So when you're talking about being able to go into a money market right now, you can go to Vanguard or Fidelity and you can get well over 3% interest in a money market account with almost no risk, always a $1 share price, access to your money every time. It's a home run compared to a stock market that is down 20% with the potential of going down even more. You see what I'm saying? And then when interest rates fall, many of the reasons why we had such a strong bear market or bull market in the 1990s or 2000s and so forth is interest rates were so low. Where did you go to make any money? You had to go to the stock market. So lower interest rates increases the attractiveness of the stock market. Higher interest rates decreases the attractiveness of the stock market because you can get a fairly decent yield on a low risk investment. Kind of goes. You got to watch how that works. So when you talk about Federal Reserve policy, this is my second chart that try to remember. When the Federal Reserve is under 3%, that is really, historically speaking, very accommodative. So as your point was made, interest rates are barely above 3% for the Federal Reserve. They've just barely breached through that in their last raise. So really, they were even accommodative up until now. Now they're starting to take a bite. It's getting neutral, and it's having an effect because interest rates were so low. It's shaking up the economy. When they start getting past 4.5% into the 5s and 6, if they get to that level, then you're talking about the strong possibility of possibly pushing us into a recession. I heard today that one of the Federal Reserve governors said this economy can withstand 4 to 4.5% Federal Reserve rate. So they think they're trying to talk up the economy yet because they don't want it to panic. But I think we're heading towards that. We'll see how inflation plays out going forward.
Even so, that's a super good mortgage rate, 6%. You're looking at long-term.
Okay, her comment was that if you have a mortgage rate at 6%, that's really still, it's not bad. Okay, well, obviously, you're younger. To anybody that younger than you, it's horrible. I mean, so many people. I mean, to me, I remember when you could get a mortgage rate at 5%, it was a home run. Remember that? I'll never forget the discussion we had at Oshkosh West with Melanie McGuire, was the teacher at Oshkosh West. And she interjected when I did this lesson on inflation. And she was talking about when her and her husband got married, that they went out to buy a home, and like the mortgage rates were like 15%. 15%. So yeah, I mean, people haven't seen inflation like this, and they haven't seen the interest rates that are going to go along with it. And it's...
Bought our first house in 2001, and it was 6.75.
Yeah.
And that was a great rate. It was a wheeler.
Yes. Yeah. We got spoiled. So, yep. So when we're talking about the price to earnings ratio, we go back, and this is a chart I said, you can go back to the 1970s. And, whoops, I'm losing my... Tighten this down or we're going to collapse. Okay, so if you look back in the 1970s, this is the price to earnings ratio. Back in 79, it got down to 7 times earnings. Investors were only willing, because they were so negative about the outlook of the economy, and we were in such a hyperinflationary environment that, I mean, I'm old enough to have remembered that. As I was just a young guy, I remember trotting to the bank, and it was nothing to get 8% on a savings account. It was. I mean, you got 8% on a savings account. So talk about competitive with a stock market that's doing so weak. Why would you put money in the stock market when you can get 8% in a savings account? So we had these tremendous low P ratios, and it wasn't until we finally got out of the inflationary environment and interest rates started going down, and then the stock market had this parabolic rise, topping out in early 2000s at 38 times earnings. Investors in the S&P 500 average were paying $38 for every $1 of earnings, where you can see the historical mean is somewhere around 16 or 17 times earnings. So it was more than double the amount that people were willing to pay, the price to earnings ratio. That is pure euphoria. And we've been running pretty consistently in the 20s throughout the 2000s. I don't know what it is right now with the sell-off, but I estimate it's going to come down as we move through this cycle. I don't think we're going to get down to 7. I don't think it's that depressing. I think the Federal Reserve is going to do its job. So the price to earnings ratio, you want to pay attention to it, and you want to see that a healthy price to earnings ratio usually is in the 16 to low 20s times earnings. If the economy looks good, you have low inflation, you have an accommodative Federal Reserve, it's not unheard of to have a healthy price to earnings ratio of 20 or 22 times earnings. I don't have a problem with that. It's when they start getting really, really high that you have a problem, especially if it's going to be accompanied by higher interest rates and inflation. So kind of like a tick, you go through the indicators that I look at. Number one, you like to see inflation running around the 3% range. That's the target. Federal Reserve says 2% on the core. You want to see productivity, at least 1% increase in productivity annually. You want to see the Federal Reserve accommodative. In other words, they're increasing the money supply as they see fit because they think that the economy is healthy enough to withstand and needs it, and they have a Federal Reserve policy, and they're not. The interest rate they're in is in that accommodative range, and that is under 5%, obviously. And they're expanding the money supply. And you want to have job growth. Our economy needs to produce between around 100,000 jobs per month to maintain a healthy economy. So when we're producing 100 and some thousand jobs a month, then that's pretty darn good. I mean, you can have seasonal fluctuations and stuff like that, but you average out a year and you're in the 100,000, that takes account demographics. That's a pretty good sign the economy's doing good. And an unemployment rate is, I mean, it's 4.5. I put this 4 3/4 to 5 3/4. That used to be a healthy, but how we've been running at these insanely low unemployment numbers for so long, and we're really, it's, in other words, I know this is why I would never run for office, because everything I say would never get me elected. In other words, it's not healthy to have such a low unemployment rate, because it means that the available skilled labor is so low that it creates shortages, and that's where we're at right now. And so, and it was interesting because I theorized, well, maybe because so many baby boomers are retiring now and they're going out of the workforce. But obviously that can't be the total explanation. Why would you have hyperinflation in Mexico then? Or in these third world countries where you have whole demographics of young people and stuff like that are available. They're having hyperinflation. It's all around the world. So, you know what I mean? That can't be the sole explanation. It's just the shortage of skilled labor. So having this really low unemployment rate right now is a problem. And one of the ways you make the unemployment rate go up is to slow the economy down. And it's going to be layoffs. Once again, it's not my campaign speech here. Okay. Okay. So you kind of have this chain of events. When you have low inflation, it's accompanied by affordable interest rates. When you have affordable interest rates, then consumers have the ability to borrow money and spend it on big ticket items like cars and homes, which are huge in the economy. That leads to job growth. It leads to corporate profits. It increases stock value. This is what we're going to finally get when the Federal Reserve gets to where we need to be. You know, so you have this constant, like that Groundhog Day. You have low interest rates, you have low inflation, you have an ample labor supply. That leads to economic growth. That increases consumer confidence, increases consumption, pricing power on the part of companies. It reduces the labor supply. This all is inflationary. So you hit this inflationary environment. The inflationary environment increases shortages of labor and raw materials. It increases the demand for money, making interest rates go up. Higher interest rates means higher cost of money, reduced ability to consume. This reduced ability to consume, consumer confidence drops, unemployment rises, corporate profits drop, and then, boom, we're right back over here. It happens over and over and over again. It's like that movie Groundhog Day. And so this is why, as an investor, when it's bleak, it's like you're like a farmer, you know, you got your seeds in the ground, that's your investments. And then this nasty thunderstorm comes in, drops 2 inches of rain. It's thundering, it's windy, it's all kind of really, it's not fit for a dog to be outside. And you're like, this is horrible. I can't go golfing today. But tomorrow, the seeds sprout. And that's kind of what you got to understand. There are things going on right now that are setting the next stage for what we need for the next economic recovery. So you don't sit there and try to time it, because it isn't like calculable by days, and you just say, okay, this is what gives me hope. This is why I need to stay where I'm at, as long as I have good investments. And you know, let all the other people go through the emotional cycle, because you're constantly in an even keel. Where is that? Here's where you want to be. You want to be, what did I do with that one? I need an assistant here. I can't find it. Anyway, you know, you want to be in that place where you're just happy with what you are and you're calm. You're not in the emotions of fear or greed.
Don't watch TV.
Well, we just have a tip from my sidekick here, is don't watch TV. Once again, you sit there and you watch the financial media. There's a phrase, was it Burton McKeel in his book? I mean, it's like where he said the financial media. Okay, if you look at any news, how much of it is good news? You know, good news doesn't sell, does it? I mean, if every day they got on and said, oh man, isn't it great? Isn't things great? And they showed one good story after another. Everybody would be switching over to the station where you got blood and guts. You know, you got the car races on there. You got people shooting each other. You got all this kind of stuff because that's what sells. And it's the same thing. And the financial community seriously has a vested interest in you doing something. In other words, how do they make money? They make money when people are selling, creating value for them to jump in because they're the buyers. They know that this isn't the end of the world. They know that the mechanisms are already in place for this recovery that is going to come and the boom that's going to come after it. And they're the guys like Warren Buffett. This is why this class is so valuable. And this is why over the years, so many times when, you'll have this tremendous selling in the stock market, it'll be the worst days ever. The market is down. Back when we had those two major recessions in 2000, 2008, I had people calling me at the worst of the markets saying, Jeff, I have to tell you, I came to your classes and that one on the economy, I am sleeping at night because I know this isn't the end of the world. I am not paying any attention to all that. I am sitting with my investments. I am calm because I understand this is a process that we've gone through before and we will go through again. And the mechanisms are being set in place for the healthier economy to come. I rest my case. Any questions? I know you're going to have a headache tonight. Yeah. Okay, his question is like, if you're in and I had someone ask me this at the beginning of the class. Supposing you've been sitting in, an example was the total bond index. So many times if you have a company 401k, they usually have something like a total bond index in there. It's an aggregate of intermediate term bonds and stuff like that. And so you've been riding it out and you're down 12%. My opinion is the Federal Reserve is going to raise even more, possibly getting into the 5s. And it's going to affect it even more. In other words, those rates are going to go down even more if inflation, because I don't think inflation is going to just disappear all of a sudden. And so you already experienced a significant drop, but it could go down even more. So you're not going to lose anything by switching to a money market account in your company retirement plan, or if they have a stable fund, or if you have an IRA going to a money market account or the ultra short-term bond fund, where you have some risk, because that'll go down even too, but you're probably going to break even or even make money. And then when do you switch? Ideally, I would time that somewhere. When you go back to my chart, when you show Federal Reserve policy. When Federal Reserve policy, if we hit the 5s, I think that the Federal Reserve doesn't want to put us in a depression. In other words, they as soon as you do think, they think that they're high enough, and I think in the 5s, possibly maybe even 6, you'll see interest rates stop rising. You'll see inflation start to behave. Somewhere, if you see a recession, if you see unemployment numbers going from positive to negative, to me, that is would be one of the keys that I would watch. Once again, I'm not a financial planner. This is not a recommendation. But this is what I would do, is I'm looking at job numbers. And to me, job numbers are really indicative of what's really going on with companies in the economic system. Because companies are always forward-looking. And if they don't see the orders coming in, they're not hiring workers, are they? In fact, they'll start even laying off. And so job numbers are going to be key in my timing on the bond market, because that will be the forerunner to inflation coming down, I think. And then I would go to like any good solid intermediate term bond fund. I wouldn't go long term. I'm not, that to me is just not my risk profile. I'm not going to junk bonds. I just go to a good intermediate term bond fund that has a duration in the 5s,
Is that the Ginnie?
and I would look at something like a Ginnie Mae, even though the duration. But I think what you'll see with a Ginnie Mae fund is I think you'll see those managers, listen, they're professionals. They know even more than me. And for years, because interest rates have been so low on mortgages, they've had a very short duration on that fund. I believe that they'll start expanding the duration and getting durations back to normally 5 or 6 years. I think that then the Ginnie Mae will be very attractive too. Because duration is the key. Going to a duration of 5 years or 6 years will be that sweet spot where you'll pick up a lot of capital gains as interest rates fall. And they'll be paying, their interest rates will go up because there'll be an infiltration of bonds with higher interest rates too.
Yeah.
Yes.
Do you agree that the actual unemployment rate is always higher than the stated rate?
Okay, his question is, do I think there's a government conspiracy? They're underreporting the it's like it's the same thing with the inflation rate. There's like, I used to listen to Bob Brinker all the time, and people would say, there's no way the inflation rate's 3%. I got my hospital bill and I got my Medicare thing and it's going up 10%. Okay, so the Federal Reserve has no vested interest in doctoring with those numbers. Where the unemployment rate gets kind of distorted is the unemployment rate is based on people who are looking for jobs. But when people just drop out of the workforce, then that doesn't, I mean, that's they're not counted in that unemployment rate, you see. So when people say, oh, there's way bigger problem of unemployment than reported, it means that some people have just given up and aren't even asking for unemployment benefits and stuff like that. They're not in the records as part of the labor supply. So I guess my answer is, could be. It depends on, but how do you quantify that? You go out and survey everybody and knock on their door and say, you know what, did you just drop out of the, Because you can look at, like right now, so many people in the baby boomers, they potentially could still work, right? They could be working part-time, but they're just not working because they're collecting unemployment, or they're collecting Social Security, and we're getting big raises there and just booming. Any other question?
You had money in an intermediate curve bond fund, okay? Would it be a good time to move some of it over? Would you move it over to short, all short?
Or his question is, once again, I've for the third time, I'm not recommending anything here, but if I was sitting in your seat and I'm looking at the fact that the Federal Reserve has said they're going to raise 1 or 2 more times, why do I want to burn my butt even more? And so when you have the option, as long as it's inside like an IRA or a 401k where you can do it without costs and without taxes, why not? But if you're sitting there and you've had an intermediate tax-exempt bond fund, and you've been in it for a long time and stuff like that, you might have capital gains taxes to sell it and so forth. Then you're probably, and you're going to get nothing on the short-term end, so I probably would just sit in it in that. You know what I mean? All right. See you next week. Thank you.